The 2022 crypto market crash explained. Since reaching an all-time high late last year, Bitcoin and other cryptocurrencies have been collapsing. Bitcoin was worth $69,000 in November 2021, but today it's valued at nearly $22,000. Ethereum as well has lost about 80% of its all-time high value. For the first time since January 2021, the total market value of cryptocurrencies has fallen below $1 trillion. Many experts believe that the 2022 crypto crash is linked to the drop in the value of stocks and other assets. This is mainly related to the strict financial regulations implemented by central banks to control inflation. When banks restrict the amount of money circulating in the market through increased interest rates, less money is available to spend on assets such as cryptocurrencies. So what's the real reason behind the crypto crash, and how could Fed rate hikes impact the cryptocurrency market? For the best and latest crypto and blockchain videos, make sure you subscribe to my channel and hit the bell icon to be the first to get the latest updates and news. So, what's the real reason behind the crypto crash? Several governments have taken actions to discourage the increase in cryptocurrency adoption. While some countries such as Russia and China have officially banned cryptocurrencies, others such as India are significantly taxing and limiting them. Cryptocurrencies are a huge source of concern for both central banks and governments. These currencies make people question central banks' authority over a country's currency and governments' capacity to fund their projects by printing new money. Cryptocurrencies are also subject to high volatility. They crash and recover all the time. Generally, when a market falls, there is a great deal of panic and most people start selling their assets. This also applies to the cryptocurrency market. These purchases have previously rewarded countless crypto traders. They assume that, like gold, crypto assets provide price inflation protection. Cryptocurrencies have thrived by positioning themselves as alternatives to the traditional banking system. However, the latest crypto crash has seen markets collapse, investors panic sell assets, and even a bank run has renewed calls to regulate the crypto industry. In other words, the crypto crackdown is on the way, and what evolves may resemble the old banks, stock markets, and investments that businesses have long mocked. According to some experts, the crypto price drop indicates that investors' risk appetite is declining. They certainly try to avoid risky investments. With all of its volatility and lack of widespread regulation, crypto can be one of the riskiest investment instruments. Since last month, the volume of crypto liquidations has been considered as investments appear to have panicked. Bitcoin and Ethereum have dropped by up to 70% and are presently trading at their lowest levels of $17,800 and $900 respectively. While altcoins have generally underperformed Bitcoin, they face additional pressure, this time due to possible regulatory restrictions. According to a CoinDesk analysis, only a tiny number of altcoins are expected to withstand such a market crash. The collapse of a supposed stable coin, Terra USD, which wiped over $40 billion in market value, has intensified a deleveraging wave that has yet to run its course. The Celsius network, holding $20 billion in crypto deposits and loans, filed a bankruptcy, and we'll dive deeper into the Celsius case in a separate video. The actual reason the cryptocurrency market is collapsing, though. Bitcoin and the other nearly 19,000 digital currencies are up against the Federal Reserve's first tightening cycle to control inflation. How could Fed rate hikes impact the crypto market? The Fed raised interest rates by 0.75 percentage point, the most significant hike since 1994. But this has also put a strain on the crypto market. The double whammy of high interest rates and high inflation could bring about a prolonged recession. The crypto market suffered heavy losses due to the rate hike and inflation. However, crypto is presumed to resume its upward trajectory when inflation is tamed. Oliver Gale, the co-founder of Panther Protocol, believed the inflation to be transitory and a mere bump in the road. But whether inflation can indeed be tamed in the near term remains to be seen. The space has never experienced a high interest rate environment, having rallied through the past 2 years on more lenient monetary policy. Therefore, cooling inflation and a reversal by the Fed may result in a bounce back of the crypto market, but the latest indicators show that the inflation may just be getting started. The 2022 cryptocurrency market crash is similar to when the dot-com bubble burst in 2000. Changpeng Zhao, CEO of Binance, the biggest cryptocurrency exchange in the world, compared the current cryptocurrency market crash to the dot-com bubble burst in 2000. While some companies will not survive the current crypto winter, the underlying blockchain technology will endure, the cryptocurrency billionaire said during a pre-recorded video at DIFC FinTech Week, a two-day event for key fintech players to discuss future drivers of the growth of financial services. Blockchain is a proven technology, he says. Some cryptocurrencies may drop in value, some projects may vanish, but the technology will remain, Zhao added. This is similar to the dot-com bubble. Many companies failed, but the technology remained. Zhao debuted on the Bloomberg Billionaires Index in January with a net worth of $96 billion. However, his fortune has plummeted to $20 billion after a sell-off in digital currencies across the board. From Bitcoin to Ether, Solana, Cardano, and Shiba Inu, among others, causing the total market capitalization to fall below $1 trillion. According to CoinMarketCap, Bitcoin is down more than two-thirds from its high of around $69,000 last November. Bitcoin has increased its links in the Middle East and Europe after getting permission to operate as a virtual asset broker-dealer in the capital in April. This is a very risky industry, so manage risks carefully, diversify, and don't go for high returns, Zhao said. He said the blockchain fundamentally transfers value similar to how the internet is used to share information. The internet revolutionized the way we live and do business long ago, and blockchain will do so even more. It will change how we think about investments, fundraising, and financial transactions that are impossible with traditional economical methods, Mr. Zhao added. Some solutions provided by decentralized finance, DeFi, today are not offered by traditional finance such as global fundraising. Zhao said entrepreneurs could raise between $10 million and $40 million in weeks or days using DeFi. This is not possible in the traditional financial industry. It could take several months or years to raise a similar amount from venture capital firms. Artists and content creators can now also monetize their work globally using non-fungible tokens, which could not be done quickly through traditional art galleries. DeFi could help provide financial services to the unbanked population. Forward-looking, innovation-driven banks will adopt blockchain technology in a big way. Zhao said those that don't adapt would have a tough time in the future, and those that are late adapters will be at a significant disadvantage. Failure is important in this industry because it allows you to learn and improve. So what should we do in a crypto market crash? In its early years, a relatively small number of people grasped that Bitcoin had a potential to be the single most disruptive economic technology invented in history. With ownership levels now in the hundreds of millions of people and governments embracing Bitcoin and cryptocurrency as a whole, the stakes are now higher than when Wired magazine declared the death of Bitcoin in the first crypto winter of 2011. We're in a volatile market, no doubt, and no one knows how the Bitcoin story will ultimately play out. But what we do have in hand is nearly 14 years of Bitcoin history to draw upon as we look ahead. In the past decade, billions of dollars of capital have been invested in crypto assets, related applications, and infrastructure. The billions more recently raised by investment firms deployed over the coming months into NFT infrastructure and other broader crypto asset areas means this crypto winter may prove milder than past ones. Several studies in recent years have shown that young people, in particular, see crypto assets as an essential part of their future. If demographics are destiny, this adoption characteristic may be the most significant underpinning of an optimistic outlook. So should we expect this latest price collapse to follow the historical pattern where Bitcoin price eventually rebounds, achieves a new all-time high, and delivers an even more significant number of total owners? As always, past performance provides no guarantees, but there's something we can say with certainty. Such a result would be nothing new for Bitcoin. Thank you for taking the time to watch this video. Don't forget to smash the like button and subscribe to be the first to watch the coming videos for more crypto, Web3, NFT, and blockchain updates and news.